Just a few months ago, President Trump signed an executive order titled Democratizing Access to Alternative Assets for 401k Investors. That's a pretty big deal for alts, isn't it? Tell me, let me start with you, Andy. What kind of impact will that have?
Sure. So I think the impact is right there in the name of the order. It's meant to be bold. Now, if you look at the text of it, it's general and broad. But here's what I think it says at a very broad and general level. It says to plan fiduciaries that you can't hide behind your fiduciary duty to block alternatives from your 401k plans. And I think that's a really powerful statement because a lot of plan fiduciaries say, well, if something's expensive, I should always pick the cheaper thing. That's an easy quantitative standard that I can apply. And the order says, well, it's not just about cost. There's an element to alternatives that is important. Access to it is part of your fiduciary duty, and you need to be able to provide it to your investors so that you're not blocking them from all the opportunities that are available to all these other investors.
They do say specifically within the executive order when it's appropriate for the particular investor, correct? So there's some wiggle room there.
Yep.
Yeah.
Well, and I think too, the other, just a level set on the market, I think what the executive order is doing is it's broadening the landscape, right, for how you think about creating a diversified portfolio. For investors particularly that are looking for global diversified access to economic growth, you have to look beyond the stock market. 86% of companies today with more than 250 million in revenue are privately held. That statistic alone is staggering, right? So it is opening the market and the ability for retail investors to access a completely new submarket. For them, obviously, you need to do it with the right guardrails, right? Michael and Mary both touched on this. That it needs to be an appropriate sizing within a portfolio. You need to have the right diligence involved. You need to be partnering and investing with the right groups that have the right people, the right process, and the right track records. But it is staggering just the access alone that it should allow.
There's fewer and fewer publicly traded stocks in the world. They've been declining for years. What kind of alternative assets are we talking about, Mary Elizabeth?
Very broad, right? And it goes significantly beyond private equity, right? So owning the equity of private companies. There's also private credit, right, which is extensive. So you can own corporate debt of private companies. You can own asset pools of asset-backed vehicles or strategies. You can own stressed or distressed debt. You can own, the credit is significantly broader than just corporate debt. There's real estate, there's infrastructure, energy. We could go on and on. And there's various levels of the capital stack, right, in which you can invest, and across industries. When you look at industry exposure of the private world, it is significantly broader and deeper than what you can see from what you're able to access in public markets today.
And what kind of timeline are we talking about, do you think, Andy?
I think the timeline is going to be relatively slow. And the reason why is while plenty of alternative investment product already exists. There's non-traded BDCs and non-traded real estate investment trusts and even hedge funds that can be ERISA compliant and can go into 401k plans. It just takes time for something this revolutionary to actually make its way through. My expectation is some of the earliest ways that investors will be able to get access to this, it will be through pooled investment vehicles like target date funds. So target date funds are already a delegation by the investor to a third-party investment committee to build something that is risk appropriate for my target retirement date. And that actually gives that investment committee the option to invest into a longer-term time frame, which is precisely appropriate for 401k. These are retirement monies, in many cases not targeted for use for many decades.
What kind of risks should people be thinking about? There are skeptics about this idea who are concerned about the risks.
Sure. So I think the most clear risk is liquidity. And I think there's an inherent mitigant in 401k plans and any kind of retirement assets on liquidity. A retirement asset is generally meant to be used decades away from today. So unless you're very close or already in retirement, giving up liquidity is not generally a major concern because you're intending these assets to be used many, many years into the future. So a mitigant to that, I'd say the other risks really boil down to due diligence is much more difficult in private alternatives. And I think the way that plan fiduciaries are likely to be able to respond to that risk is they will lean on the largest, most well-capitalized institutions that have track records, that have something that they can lean on as their own due diligence for, I've identified a good way to invest for my plan participants.
Do you need different kinds of managers, Mary Elizabeth, when it comes to this?
I feel like that was a layup. Absolutely. Without a doubt, right? Because the universe is so expansive. You need managers across asset classes because they are going to have the expertise to go deep into various sectors, into various asset classes. I mean, it just is and it takes the diligence in order to unearth those managers. Obviously, there's the KKRs and the Blackstones of the world. They're fantastic and have unbelievable track records. But it goes significantly beyond the infrastructure, it goes beyond the people, and beyond the track records.
What about, you mentioned cost. You said one of the reasons you thought people were hesitating at the top was because of cost.
Sure.
What about the costs? They are higher, right?
So, and there's no question, a private alternative asset has a higher cost because it has a higher effort on the part of the manager. It's easy to buy a basket of 500 stocks. We have computers that can automate that order flow, that can create a really good portfolio that tracks the S&P 500 index. There's no index of private alternatives, or except to the extent that there are, they're really measures of how everybody else's fund did. So it's not really possible to construct an index portfolio of private alternatives. It's more work for the manager, which means that they do require more compensation. And is it, at the end of the day, worth it for the end investor?
That was my next question, yes. Is it worth it? Yes.
And I think it is. And the reason why is it broadens your diversification set. To Mary Liz's point, you're excluding a lot of the investable businesses if you're only willing to trade what's public. It also enhances your potential for return. One of the biggest reasons to own an illiquid asset is what we in finance would call to earn an illiquidity premium, which can, if you look at long-term trends, can be as much as 2 to 3% over a public market comparable. And again, thinking about long-term money, getting an extra 2 to 3% per year to compound in your favor for decades at a time can be a really powerful way to grow wealth.
Certainly. Right. Last word.
I would just add, last thing is sizing is incredibly important, and how you think about a diversified allocation. We at Corient really set the guardrails, right? We think an appropriate allocation to alternatives is anywhere from 10 to 20%. Obviously with lots of caveats, right? The client has to meet the suitability requirements and the investor guidelines, right? But that alone is a massive risk mitigant when you just think about it from a sizing standpoint. And that's going to be something that is going to be a huge headwind for the 401ks to think through. How do we create these guardrails within the system to protect investors from themselves?
Always important. Thank you so much. This was terrific. Really appreciate it.
Thank you.
Thank you.